Hi, everyone. Thank you so much for joining us this afternoon for our webinar on alternative strategies to build credit. We apologize for being 2 minutes late here to get started. We had a brief technical glitch with uploading the PowerPoint. So I think we're good to go now. All right. Nikia, can you just confirm that we're ready to go on your end?
We are ready.
Excellent. All right, perfect. All right, thanks again, everyone, for joining us. My name is Michael Rausch, and I am the Director of the Real Economic Impact Network at the National Disability Institute. I'm excited that we have Carmina Lass with us, who's the Director of Training and Consulting at Credit Builders Alliance, who's going to share some information with us on alternative strategies to build credit. This is really an important topic for us to have a discussion about, as well as we receive a lot of technical assistance questions pertaining to alternative strategies to help individuals build credit. I would like to say a special thank you to our sponsor, to Bank of America, who's been a longtime supporter of the Real Economic Impact Network here at the National Disability Institute, and they are sponsoring today's webinar. So special thank you to Bank of America. Before we get started into our presentation, we would like to cover some housekeeping tips. And so at this time, I would like to turn it over to my colleague, Nikia Matthews, who will share this information with us. Nikia?
Good afternoon. The audio for today's webinar is being broadcast through your computer. Please make sure that your speakers are turned on or your headphones are plugged in. You can control the audio broadcast via the audio broadcast panel. If you accidentally close this panel or if the sound stops, you can reopen it by going to the Communicate menu at the top of your screen and choosing Audio Broadcast. If you do not have sound capabilities on your computer, or if you prefer to listen by phone, you can dial the toll or toll-free number that you see here and enter the meeting code that you see here. Please note that you will be asked for an attendee ID, but you do not need to enter one. Real-time captioning is provided during this webinar. The captions can be found in the Media Viewer panel, which should appear in the lower right-hand corner of the webinar platform. If you do not see the captions, you may need to open the Media Viewer panel, and you can do so by choosing the Media Viewer button in the upper right-hand corner. If you would like to minimize the Media Viewer panel, you can do so, or if you'd like to maximize it, you can close some of the other panels like chat or Q&A. I will also be pasting the link for the captions in the chat box in case you'd like to view them in a separate browser window. There we go. There will be some time for questions at the end of the webinar. You can send them via the chat box, or you can use the Q&A box. Send them to either Michael Rausch or to NDI admin, and we will direct those questions accordingly. If you are not logged in by phone, if you are not logged into the web portion and listening by phone only, you may also have your questions asked by emailing them to Michael at mrausch@ndi-inc.org. Please note that this webinar is being recorded and that the materials will be placed on the NDI website. Finally, if you experience any technical difficulties during the webinar, please use the chat box to send NDI admin a message, or you can email me directly at nmatthews@ndi-inc.org. Michael?
Great. Thank you, Nikia. Thank you, Nikia, for sharing that information. We appreciate it. So just in case there's anyone who's new to the National Disability Institute, I just want to share with you some brief information about our organization. At the National Disability Institute, our mission is to drive social impact to build a better economic future for people with disabilities and their families. At the National Disability Institute, we have the Real Economic Impact Network, which is a network that consists of more than 4,500 members across the country. If you're not a member of the Real Economic Impact Network, please feel free to join us. It is free to join. And you can learn more by going to our website at www.realeconomicimpact.org. And it will provide you a list of all of the things that you receive by being a member of the Real Economic Impact Network. And again, it is free to join, so please join us. So, because we have a lot of information to cover, I want to make sure we have plenty of time for our guest speaker to share that information with us today. So on today's webinar, we are going to look and understand what is credit building, okay? It's really important that we understand the difference between credit building and credit and debt remediation, all right? And so we are going to be able to understand the difference between the two. We're also going to understand the importance of credit building for the individuals that we provide services to. If you've been involved in some of the webinars we've done in the past, particularly with integrating financial education into workforce development programs or the American Job Centers, we have shared the importance of credit with employment outcomes. And so today we're going to really understand the importance of that as well. And then we're also going to look at how secured cards, credit builder loans, and rent reporting are helping individuals build positive credit. It's important for us to look at these alternative strategies to be able to help an individual build their credit. And oftentimes, individuals and practitioners may not be familiar with these different types of options. And so that's what we want to make sure to cover today. As I mentioned, we receive a lot of technical assistance questions regarding each of these different topics: secured cards, credit builder loans, and rent reporting. And so we're excited that we're finally been able to bring this webinar to you all today. And for our webinar, we are joined by the Credit Builders Alliance, who is a partner of the National Disability Institute. And today's presenter is Carmina Lass, who is the Director of Training and Consulting at Credit Builders Alliance. As the Director of Training and Consulting, Carmina leads the development, marketing, coordination, and delivery of Credit Builders Alliance's education, training, and consulting services. She also provides support to Credit Builder Alliance's reporter and access team, creating innovative and entrepreneurial services to meet Credit Builders Alliance clients and partner needs and carrying out the mission of the organization. Carmina comes to Credit Builders Alliance with over 5 years' experience as a nonprofit practitioner, through which she focused on economic empowerment, financial capability, and lending among low-income and underserved communities. Carmina has a master's degree in conflict resolution from Portland State University, where she concentrated on intercultural conflict resolution, dialogue, reconciliation among divided communities, and microfinance strategies for poverty alleviation. So with that, we are grateful to have Carmina with us today and to share information with us on alternative strategies to build credit. Carmina, with that, I'm going to turn it over to you.
Wonderful. Thank you so much, Michael and Nakia, and thank you to the National Disability Institute for inviting CBA to present to your network and also just for your ongoing partnership. So I'm excited to present this webinar to you today, Alternative Strategies to Build Credit. Before we get started, I would like to just give you a brief introduction to CBA, give you a little bit more information about what we do. CBA is a national nonprofit intermediary organization created by and for our nonprofit members in response to the need for low and moderate income individuals to gain or regain access to the modern financial system by building credit. Our mission is to help move people from poverty to prosperity through credit building, and we believe that having good credit is an asset, but that not everybody has access to the responsible, affordable credit that they need. Underscoring our philosophy that a good credit file is essential to achieving and maintaining financial stability, it is our belief that mission-driven nonprofits and other entities are uniquely positioned to help individuals and families build credit as an asset, and often as the foundational asset necessary to get and stay ahead. By taking an asset-based approach to credit, the focus becomes one of empowerment, what the consumer can do now to build credit through future positive financial behavior, rather than what he or she has done wrong in the past. As you can see, we have a membership that spans the country, all 50 states and Puerto Rico. Our diverse membership of over 470 organizations includes nonprofit lenders, community action programs, United Way and Goodwill affiliates, Habitat for Humanity affiliates, small community credit unions, workforce development programs, domestic violence shelters, refugee resettlement agencies, affordable housing providers, and many, many more. Through CBA's unique credit bureau partnerships and our robust technical assistance, we support our members in their efforts to improve outcomes for their clients and organizations. We have one-of-a-kind intermediary umbrella arrangements with the credit bureaus that enable CBA members to access credit reports and report loans to the major credit bureaus. We also offer virtual and on-site technical assistance to nonprofits, asset-building coalitions, funders, and others in the development and measurement of credit-building programs through our Credit as an Asset training and consulting services. And we are constantly expanding and deepening the value add of our credit-building community. CBA members benefit from a robust learning library of tools and resources, as well as a monthly members-only webinar series that convenes industry leaders, including representatives from credit bureaus, credit score modelers, government regulatory agencies, and of course nonprofit practitioners who come together to keep our membership well informed of ongoing industry changes in credit reporting and consumer protection, as well as best practices in nonprofit lending and credit education. As I mentioned, through our reporter service, we make it possible for nonprofit lenders to report loan payments to all 3 of the major credit bureaus, as well as to commercial credit bureaus. And currently, we have 181 active CBA reporters who report over 35,000 trade lines we report over 35,000 trade lines on their behalf of their borrowers, worth over $1.17 billion to consumer credit bureaus. And in addition, through our business reporter service, CBA member organizations report $89 million in small business loans to commercial credit bureaus. Through our Access service, we offer nonprofit lenders and financial education providers the opportunity to become credentialed to pull hard and soft pull credit reports at discounted rates from TransUnion and Experian. And currently we have 383 CBA Access members who are pulling over 8,899 consumer credit reports each month through CBA. These organizations use the reports for credit coaching, client outcome tracking, as well as loan underwriting. And if you're interested in CBA membership or any of our services, I'll provide some information at the end of the presentation about how you can get in touch with us to learn more. So let's talk a little bit more about why we feel that credit building is so important. It probably goes without saying for you, but good credit is like a passport to the new economy. It can open many doors and opportunities for financial stability and asset building, and without good credit, sometimes these doors can remain shut. Many low-income households, which may include many of the clients that you work with, have only experienced credit as a barrier, something that has prevented them from accessing housing, employment, or financial services. However, at CBA, we really believe that it is critical to help these clients reshape their understanding of credit and to build credit in order to access the essential products and services that they need. Just to provide a little bit of context with some facts about credit realities in the United States, there are approximately 64 million U.S. consumers with no credit or a thin file. And we also know that there are approximately 26 million consumers who are credit invisible. And that means that they have no information on file to generate any type of credit report at all. Another 19 million consumers may have some credit information in their file, but it's not enough information to actually be able to generate a credit score. In addition, according to CFED, less than 50% of Americans have what is considered prime credit scores, which would allow them access to good or the best rates on loans. In addition, these credit realities that I just described do tend to be more concentrated in low-income communities and especially among minority consumers. And we do see throughout our membership the same trends among organizations serving people with disabilities. Many people with disabilities also have credit challenges and are credit invisible due to constraints of limited and fixed incomes, as well as other credit issues that come into play, such as medical debt and collections. In all these cases, people pay more for financial products and services when they have no credit or poor credit histories than those with good credit histories and scores. In fact, it has been estimated that a consumer without good credit may pay as much as $200,000 more over a lifetime for credit than somebody with an excellent credit score. Good credit not only improves access to products and services, it also increases options. So it's not only a prerequisite for everyday financial services like a low-cost credit card, but even getting a bank account or a car loan can be very dependent on a credit rating. In addition, paying for car insurance, renting an apartment, signing up for utilities, and even a cell phone can be affected by a person's personal credit history or the absence of one. In addition, access to credit can buffer economic shocks and setbacks. Having a credit card offers instant access to an interest-free 30-day loan if the balance is paid at full at the end of the month. Compare this to the incredible interest rates and often predatory terms offered by payday lenders to those without access to affordable, responsible credit. So good credit really equals savings and contributes to households' bottom line. As we mentioned, it can save a person thousands of dollars over their lifetime, and therefore credit building is really a sustainable and systematic strategy for saving money. When you have good credit, you're offered better loan rates. For example, an individual with a FICO score of 720 will pay over $4,000 less for a $10,000 5-year auto loan, saving $67 a month compared to somebody with a score of 500. And I'd wager that for any of us, $67 extra a month is nothing to sneeze at. In another example, with a credit score of 760, a household can save almost $70,000 over the course of a 30-year, $100,000 mortgage, and that comes to $192 a month. Another place where we see lots of savings in terms of having excellent credit is car insurance. And in many states, drivers with poor credit scores can pay a lot more for car insurance. In some extreme cases, drivers with poor credit scores in some states can pay as much as $2,000 per year more than drivers with excellent credit scores. So ultimately, good credit can really provide a significant boost to households' monthly cash flow and contribute to their ability to save. Good credit also equals access to assets. A good credit history can really make the difference in accessing the affordable lending products necessary to go to college, to buy a home, or to start and grow a small business, 3 of the most widely promoted asset building options. And while a good credit history and score can mean lower fees and interest, as we saw in the previous slide, a thin credit history or none at all can make it difficult to qualify at all for affordable credit products from traditional lenders. So we've talked about the importance of credit and credit building, but let's make sure we're all on the same page and define what that means. So while credit building may indeed involve credit and debt remediation, credit building is distinct in that it really requires a linkage to an actual credit product. The focus of credit education, as we all know, is to help individuals build knowledge and skills to understand and address their credit practices, and the focus of credit remediation is primarily on dealing with errors and outstanding debt, whether current or in collections on their credit reports. Credit building's focus, on the other hand, is the establishment and successful maintenance of an active trade line that could show up on a traditional credit report, which historically means either an installment loan or a revolving credit product like a credit card, but these days, as we're going to talk about later, involves there's a lot more opportunities that for credit building available. So we'll define what an active trade line means in just a moment, but having positive active trade lines on your credit report is really the only way that somebody with no credit or a thin credit history can establish or reestablish a credit score. And in many cases, adding an active trade line is also an effective and faster first step than dealing only with debt for those with poor credit profiles who wish to boost their credit scores. So the bottom line, it's no longer enough to have bad credit, you must have good credit. So to summarize, building credit is simple. It means establishing and maintaining active trade lines by making on-time payments that are reported to a credit bureau every month. And just to clarify what we mean when we're talking about active trade lines, lenders report both installment loans like car loans, student loans, mortgages, and revolving credit such as credit cards or lines of credit to the credit bureaus. For active installment loans, in order to be active, they must carry a balance and require a monthly payment. So that means that while paying off debt is a great thing, once paid in full, a loan, such as a car loan, is no longer active once it's paid in full and won't continue to build credit. And eventually, if an established credit score will disappear if a consumer has only that one trade line that has been paid in full. Revolving credit, on the other hand, offers an indefinite credit building solution as long as it is actively used. And by active, we mean used at least once every 6 months. But ideally, for the best outcomes in terms of credit building, active means using that credit line monthly. So it's important to note that an outstanding balance on a credit card is not required to build credit. That's a common misconception that we see among our member clients, that people expect that they must maintain that balance and pay interest on that balance, but that is not true. So many credit building practitioners recommend that clients use a credit card once a month for a small essential purpose like gas or groceries, and then pay off the balance at the end of each month in full without paying a cent of interest and still being able to build their credit. And just a couple other notes on active lines. First of all, open does not equal active. So as long as somebody has a trade line, that doesn't necessarily mean it's building credit. So if you have an old credit card that you're not using, that's not necessarily building credit. Another note is that, late payments do happen, but time heals all wounds. So we always, we don't advise people to, abandon a credit card, let it go, continue to grow, get a more severe negative status. If they've missed one payment, getting back on track is the best way to continue their credit building actions and recover from that missed payment. Student loans, often people have those that are in deferment, and those are not active when they're in deferment, but they have the potential to be once payments resume. Installment loans, such as for a car or a personal loan, no longer builds credit once it's paid in full, as we have already mentioned. Many consumers may want to pay off loans as quickly as possible, but that doesn't always further their credit building goal. And finally, collection accounts are never active trade lines, so even if payments are being made, such as on a payment plan, they're not actually building good active credit. So what we've seen in the last 10 years from our members is that they've identified some best practices around credit building, and that is that ideally consumers should have 3 active trade lines with a mix of account types, so at least 1 installment and 1 revolving trade line, and have established a history for at least 6 months in order to have enough time to establish a score. And while 3 active trade lines is the recommendation, our members have seen that people who are starting out with no credit or only old credit history, and if they're adding only 1 installment loan as little as $100 and paying it on time, they have been able to establish a score in the upper 600s and can increase their score by an average of 35 points if they're starting with a score in just 6 months to a year. In addition, our members have really recognized the importance of pairing access to responsible credit products with high-quality credit education, which in many cases takes the form of credit coaching or credit classes. Okay, so we really believe that credit building is financial capability. So according to the Center for Financial Services Innovation, if financial literacy is what you know, financial capability is what you do. And credit building is really all about financial capability, moving from financial education, which reflects knowledge gained, to financial capability, which results in longer-term behavior change by pairing education with active and successful use of a product. And we've seen this done with IDA programs, with second chance bank accounts, and now with credit building. By combining financial education with financial products, every monthly payment is an opportunity to reinforce positive behavior change and continuously show that you can manage your money and work towards your goals. However, we end up back here at the credit catch-22. For many of the people that we're working with who have no credit, thin credit, or poor credit scores, it's really difficult to build that good active credit because without the credit score, without the good credit score, you don't qualify for the products that you need, the loans and the credit cards. So the good news is that building credit is really no longer limited to the loans and credit cards that are only available through traditional financial institutions. Lenders across the country, both small and large, are really now innovating to create products designed for and available to communities who have been traditionally underserved. So these types of alternative products and strategies include starter products like credit builder loans, which we'll discuss in a moment, and secured credit cards. We also are seeing lots of different special purpose consumer loans that are out there, and these are loans that are designed to meet both a specific need for capital and build credit at the same time. So examples include immigration loans, assistive technology loans, and many more. Many of our own CBA members are really on the cutting edge of designing these types of new products. In addition, we have social lending programs such as lending circles that are now offered by CBA member Mission Asset Fund, and they are offering those all across the country. In this model, people come together in small groups and save a fixed amount of money each month for a set period of time, such as a year. They then take turns taking the pot, and payments are reported to the credit bureaus. Organizations can now start lending circle programs in-house with the back-end logistics managed by Mission Asset Fund. In addition, we'll talk briefly in a moment about rent reporting, which is a new and growing way for renters to establish and build credit. And finally, score modelers such as FICO are also innovating to really better meet the credit needs of no-file and thin-file consumers, designing alternative scoring models that use non-traditional information such as public records, address histories, occupational licenses, and more to offer lenders a way to evaluate consumers who can't be scored by traditional scoring models. We're seeing lots of different ways that our members are finding ways to offer credit building strategies to their clients. So we're seeing, and I just want to note that none of these are mutually exclusive, but we're seeing organizations that are creating great strong referral relationships with financial institutions, so they're learning about the products that they offer, they're learning about the eligibility criteria, they're educating the financial institution about their target market, and they're creating great opportunity to get people in the door well informed about how to qualify for those products. We're seeing organizations partner with responsible lenders, nonprofit community development financial institutions, both local and national, to offer products. And we're also seeing a lot of our members who are lenders, of course, are offering and reporting their own products. It's critical if you are designing products or assessing products that you want to offer to your clients, that you want to ensure that these products are really going to be the right fit, and that includes a careful understanding of the criteria and terms of the products, finding lenders who are willing to work with your clients and understand maybe the specific challenges and constraints they might be experiencing. And also you want to make sure that any credit building strategy does not end with the final payment on the first product. So, if you're starting out with a starter small dollar installment loan, it's important to make sure that you and your client have a plan for the next step for moving forward and graduating to other credit building products to continue their progress. Like I said, we're seeing so many different innovative products that are out there helping people to build credit. In addition to just building credit, some of these loan products can really serve a lot of different types of people and purposes, such as reducing dependence on predatory products through payday loan alternatives and consolidation products. They can help people manage monthly or unexpected expenses, purchase a specific need, such as assistive technology, build savings and assets, and build small businesses. In order for these products to be successful, they do, of course, require the capital and infrastructure needed to manage a loan fund, but they also require the cultural competency lens that nonprofits can bring to a partnership with financial institution or through the design of the product itself. So you know what your target market needs in terms of credit, and you also know what needs to be in place to make them successful. Earlier I mentioned credit builder loans, and so I just wanted to give you an idea of what that type of product can look like. This is an example of a credit builder loan product that's offered by one of CBA members, Innovative Changes. And Innovative Changes is a nonprofit CDFI loan fund in Portland, Oregon. Their credit building loan is designed to help people establish and reestablish positive credit in order to improve their credit score and meet their goals. So unlike most any other type of loan where a consumer takes out the loan and they receive the loan funds up front and pay it back over time, credit builder loans work a little bit differently. At the time that the loan is made, the funds are actually put into a special borrower's deposit account, and they're held by the lender, in this case Innovative Changes, until the loan is paid back in full. So it's definitely a unique model, but as a result of this program, Innovative Changes is able to offer the loans to clients with no or challenged credit because there's not a risk of loss of the loan funds. And borrowers can choose, they make the product flexible by allowing borrowers to choose the size of the loan, enroll in automatic withdrawal on a date of their choosing, and also participate in credit education to make sure that they're on track to meet their goals. payments on the loan are reported to all 3 credit bureaus through CBA in this case. And to cover the costs of making the loans, Innovative Changes does charge application and loan processing fees. In other credit building loan models, lenders, in particular credit unions, which are we're seeing them offering these, might charge interest in addition or in place of the fees. Innovative Changes has seen many clients move on to homeownership and the achievement of other asset building goals after completing the Credit Builder Loan Program, and oftentimes clients are also, heavily involved in credit coaching and actively working on other issues at the same time that they're making payments. The results really speak for themselves. On average, clients who are starting the program with no score at all are able to establish a score of 677. And those who did have a score at the onset were able to increase their score by about 42 points on average. So credit builder loans are a great starter product, as are secured credit cards. Secured credit cards are, they do require the borrower to have funds to cover the cost of an initial deposit, but basically it's a credit card that's backed by money that the consumer themselves deposits and keeps in a bank account as security for the card. And if you don't pay, of course, if you don't make your payments on the bill, the deposit can be used to cover the debt. After successful management of a secured credit card product, financial institutions can, may be able to graduate that consumer to an unsecured card. Okay. I also wanted to highlight another great product model of success from one of our members, and this is more of one of those specific purpose loans, and that is what's offered by the Washington Access Fund. So CBA member, Washington Access Fund, whose mission is to provide funding for people with disabilities in Washington and Oregon to purchase assistive technology and achieve greater independence. So they offer assistive technology loans up to $25,000 in Washington and up to $10,000 in Oregon with 5% interest rates. In addition to these loans, they also have an IDA program and offer small business loans. So this is really a fantastic example of how an organization is creating products that truly meet the credit needs of their target population. So you might be thinking, okay, there's all these great examples, but how do I find credit building resources for my clients in my community? We definitely encourage you to join our credit building community in order to benefit from the tools, TA, and networking opportunities that we offer. But at a minimum, you can locate CBA members in your area through our website to see if there are members that have services that your clients can benefit from. So we have a tool on our main page of our website, which you'll have the contact information at the end, and you can search for members in your area. In addition, another great tool that you can use is assetplatform.org, and that is a tool that allows you to search for credit unions in your area that offer products like credit builder loans and secured credit cards. So you need to create an account on their website, but it's totally free. So you just create a login, and then you can go to their organizational resources tab and search for credit unions in your area that have those types of starter products, and then you can further research if those would work well for your clients. Just another resource is NerdWallet. In addition to offering reviews of credit cards, including secured cards, they are also working on compiling a database of payday loan alternatives that include many nonprofit lenders and CBA members. It's just another database to check out. I also wanted to touch briefly on rent reporting, which is another emerging credit building strategy. Traditionally, the only time your rent would show up on your credit report and impact your credit score was if you owed your landlord a significant amount of money and then they sold the debt to a collection agency. In the past, very few landlords were reporting any on-time payments to the bureaus, and the bureaus actually didn't have a system for collecting that information. The credit bureaus realized that was a huge blind spot in terms of you know, the ability to assess creditworthiness of a growing population of renters. And so in recent years, all three credit bureaus have kind of come on board with rent reporting. And CBA is now really working with affordable housing providers to be able to design and implement rent reporting for credit building initiatives that provide residents with the opportunity to combine the ability to get rent payments reported with integrating financial education programming. So we see rent reporting as a win-win-win for affordable housing providers and their clients. Renters can build credit without assuming additional debt. And so basically they add a new active trade line that builds some credit just with what they're already doing, which is making their on-time rent payments. And then it improves access to traditional affordable credit products as well as new opportunities in housing and employment. For resident service providers, it offers the opportunity to convert financial education programs to financial capability programs with the inclusion of a product to wrap around their education and coaching programs. And property managers benefit by having a low-cost way to incentivize on-time rent payments, as well as a competitive advantage in recruiting new residents. CBA completed a multi-year pilot in which we worked with 8 affordable housing providers to understand the impact of rent reporting. And in the interest of time, I'm going to go through this quickly, but ultimately we found really compelling results in terms of the inclusion of positive rent payments on residents' credit reports. So we've expanded our core services to include rent reporting for credit building consulting. So if you are an affordable housing provider or are working with other affordable housing providers that are interested in doing that, they can definitely get in touch with us to find out more about reporting rental payments. Just a brief note about you know, on the topic of alternative strategies for credit building is that you know, score modelers such as FICO are now starting to realize that many people who are unscored by traditional credit scores like FICO and Vantage might still be good credit risks, even though they haven't participated in the traditional credit economy. So we're seeing new scores come on the market such as FICO Score XD, LexisNexis RiskView is offering products to lenders. And lenders are really actually starting to think about credit scoring, underwriting differently to expand their market and find ways to weigh traditional credit scores less or not at all in their decision-making processes. And I know I'm running out of time, so forgive me for speaking a little bit quickly. I've just got a couple more slides. Just wanted to point out when we're talking about updates in consumer credit scoring that there are some new developments that might be important for the people that you serve. We are in an era of increased scrutiny on consumer protection, and some of the most significant changes that we've seen have come out of the National Consumer Assistance Plan, which is impacting the way that debt collectors and credit reporting agencies need to treat consumer information. So one of the main developments is the fact that starting in September 2017, creditors can no longer report medical collections until a 180-day grace period has expired to allow for the time that it takes to get bills resolved with insurance. And in addition, if an account is paid in full through insurance, it has to be deleted from the credit report, so it's no longer impacting the credit report negatively. There's some other new consumer protections that are coming out, including that debt collectors must report some additional information to help consumers recognize the information that's appearing in the collection section, and debt collectors cannot report debt that didn't arise from a contract or agreement to pay and must institute a process to remove that if it is appearing. So if you are interested, if you are a CBA member or interested in becoming one, you can learn a lot more about these kinds of developments through our learning library. Okay, so just one more thing before I wrap up. We've talked a lot about all these great strategies for building credit and the importance of adding active trade lines, but it's really critical that we work with individual clients to assess that they're ready for credit building, and in doing that, we need to assess their financial their financial situation, their current credit profile, and other factors, just to make sure that that's going to be a good decision for them to be adding new credit. I'm not going to go through all these slides because we are running out of time, but we want to just make sure that we're looking at their financial stability, their credit profile, and ultimately if those who have what we call a thick file, lots of active trade lines on their report, we might want to think a little bit more critically about whether they're ready to add new accounts onto their credit line. In addition, if somebody is in crisis mode, strong tendency to miss payments, have lots of debt or collections, or even contemplating foreclosure or bankruptcy, it's definitely not the right moment to be adding new trade lines. So if you are interested in CBA membership, you can use this contact information to get in touch with us, or if you're interested in any of our services that I've mentioned, definitely get in touch with us, and we'd love to explore more about what you do and how we can offer resources to support your efforts. So I will turn it back to Michael.
Excellent. Thank you so much, Carmina. A lot of great information here. And I just want everybody to note that these slides will be available after the webinar. You will receive them, all right? So you'll be able to have that. So we do have some questions that have come in. So we have about 5 minutes, so I want to spend those looking at these questions, all right? So the first question is Credit Karma score accurate? Carmina, could you address that?
Sure, absolutely. We get that question a lot. So there's several different consumer websites that offer free credit scores, and Credit Karma is one of them. Typically, they offer a Vantage score, so it might not be a FICO score, but it definitely is an accurate score. It's just a different score model than potentially a lender might use. I mean, I could go on and on about that, but we did actually do recently, earlier this year, we did a comparison of some of those different websites to evaluate, to look at how useful those are for consumers, and they can be great coaching tools to track credit progress, and we have that webinar that we did and a tip sheet in our learning library, so if you're a CBA member or you're interested in becoming one. But ultimately, I think that those can be great tools for tracking general progress on somebody's credit score growth, but keep in mind that you do have to supply personal information in order to access the free score, and you also might be subject to marketing messages, which help those kinds of sites to earn their revenue.
Great. Thank you. We get that question a lot too, about Credit Karma and if it's accurate. So the next question is, who offers secured credit cards?
Great. So all kinds of lenders offer secured credit cards. So all the big banks offer secured credit cards, many of them, and then your small credit unions as well. So if you want to compare options, one that I mentioned is NerdWallet. Kind of compares the more mainstream secured cards, and in terms of what kind of balance is required, or what kind of deposit is needed, what are the underwriting criteria. You can look there, but also you can use that tool to search local credit unions around you to see who offers secured credit cards near you, and find one that fits with the needs of your clients.
Great. So we get this question a lot too. So what is a good credit score?
Oh, that's a tricky one. So, you know, there's lots of different, what's confusing for us as practitioners and for consumers is that there's lots of different credit scores. So it really, you know, it really depends on what credit score model you're looking at, but also what goal you're looking, you know, what you're looking to achieve. So if you're looking for home ownership, what a good credit score is to you for the rate you want to achieve, it might be different than if you're looking for a car loan. So generally, you know, the higher the credit score, the better. And you know, depending on the model, you know, anywhere from 680 to 720 and up can qualify somebody for, you know, good, but maybe not the most excellent rates.
Great. So the next question is, what if the renter's landlord doesn't report? How can rent be reported to the credit agencies?
Good question. So currently, you know, landlords do, you know, need to sign on to report rental payments. There are some services out there. One is called Rental Karma that offers rental payment verification. So you can sign up with them, and then they basically call your landlord and make sure you made the payment and then verify that. That does, of course, come with a fee, and just a caveat, we don't endorse any product or service, but that is one of the only options that's out there for an individual if their landlord isn't reporting. But we're definitely trying to, in the affordable housing domain at least, trying to get more housing providers, including public housing authorities, interested in the opportunity to report rental payments.
Great. So is that, do you know the web address? Is it rentalkarma.org, .com? Do you know? That's okay. They can Google
yeah,
it.
I can send it to you afterwards.
Great. That's a great resource. So thanks for the person who asked that question. How would you know if rental credit reporting is available?
So the first step would be to contact your landlord or property manager and ask them if they are reporting rental payments. And then if they aren't, you know, you can provide them with, you know, to give them your interest in having your rent reported, and you know, see if they would be interested in looking into it.
All right, great. So a couple more here. So regarding the credit loans, it says for the credit loan, it would be about $60 to initiate this type of loan. And then they have a question mark. So I think that's the question.
Okay. Yeah, I think the question is probably about the credit builder loans. And so, yes, those do have a cost. I mean, that particular one through Innovative Changes did have like an application fee and a processing fee, and it is a cost. Most of the people who entered into that type of loan are trying to pursue a specific asset building goal, and so that you know, that cost was worth it to them to be able to have an opportunity to build credit. It's definitely not the type of product for somebody, you know, it's very connected with the goal is what I would say. And so the costs are there because they do need to be able to cover all the costs of making that loan administratively, as well as pulling credit reports over the course of that loan. And so most of the borrowers, you know, are mostly aware of that and you know, willing to pay that cost for that opportunity.
Great. So the next question is, what is the benefit for a landlord to report rent payments?
Sure. So landlords can, it can be a way to incentivize on-time payment. You know, essentially, you know, the opportunity to build credit through rent will encourage people to be paying their rent on time. You know, it might be able to be a way to attract new residents who do want to build credit through paying their rent on time. And also, on the resident services side, what we saw in our pilot is that some organizations really had struggled with getting people involved in their financial education programs, and rent reporting was a really great hook to be able to get them in the door and be able to provide them more comprehensive services. So on the affordable housing side, and that resident services piece was really great for them.
Great, excellent. Well, thank you so much, Carmina. We're coming up to 3 minutes before the hour, and we have some great other questions that have come in. I think that with the interest here and this topic, I think we should schedule a look at doing a follow-up webinar in the future. So everyone, whenever you fill out your evaluation after you close out of the webinar, please let us know if you want to explore this topic even more and go into a little bit deeper on some of these pieces. Today was an excellent, excellent overview and providing some of the resources that we can access to be able to help our individuals that we work with. Before we close out, I just want to encourage you to join us for our grassroots campaign. If you have not signed the pledge, please take the pledge to help disable poverty. This campaign is working to increase awareness about the nearly 1 in 3 Americans with disabilities that live in poverty and remain outside the economic mainstream. At the National Disability Institute and our partners, we believe that we can disable poverty and cut poverty in half within 10 years for working age adults. So please join us and go to disablepoverty.org to learn more. If you're not a member of the Real Economic Impact Network, please join us. It's free, so go to our website. Also, I want to remind you that on September 14th, we are having a webinar on motivational interviewing, an approach that makes a real economic impact. Sue Rogan with Maryland Cash Campaign, and who's also a certified financial counselor, will be with us to talk about motivational interviewing, what is motivational interviewing, and how we can use these techniques in our employment program or financial program to motivate individuals to work towards the goals that they would like to achieve. My colleague Jamie Pendergraph works on the Maximus Project and is hosting a webinar on a Ticket to Work webinar on working for a federal contractor. It's Wednesday, August 31st from 3 to 4:30 p.m. You can register online at choosework.net/wise. These are great webinars, so please feel free to participate in this webinar as well. Please find us on social media, and here are our various addresses. I would like to close out today's webinar just to say again, thank you to Credit Builders Alliance. Thank you to Carmina Lass for sharing this wonderful, wonderful information with us today. And I also would like to thank my colleague, Nakia Matthews, for her work in putting today's webinar together. So with that, thank you again for participating, and we hope you all have a great afternoon. Thanks, everyone.